So we'll start with bond valuation first. First, question number 1. Those who have the notes, they can come to question number 1, which is from July 2021 exam. There can be a internet problem, so you can have a 5 to 8 second delay. So please cooperate. Check the internet at your end. You will be able to understand. Don't worry. I'll go today a little slow, as if I am taking a regular batch. Okay. So can we start now? Question number 1 is from July 2021 exam. An investor has recently purchased substantial number of 7-year, this is the time, 6.75%, that is the coupon rate, rupees 1000, that is face value. So this is the maturity, this is coupon, this is face value bond with 5% premium payable on maturity. So the redemption will be at 1000 plus 5%, 1050 at a required yield of required YTM of 9%. YTM is 9%. However, due to a financial crunch, he is looking to sell this bond and has got a proposal from another investor who is willing to purchase these bonds by shelling out a maximum amount of 897 per bond. So he is planning to sell this bond for 897 today. Investors follow intrinsic value method for valuation of bond. So in order to find the value of the bond, we have to calculate the present value. You are required to determine first the market price, then the duration and the volatility of the bond. So from this question we are going to cover 3 aspects: how to compute intrinsic value, duration and volatility, means modified duration. The price of the bond today is the present value of all future cash flow. What is the duration? Duration is the average time required by an investor to recover his investment, and volatility of the bond means will take modified duration. It measures the relationship between change in the yield and the bond price. Required YTM of the investor. So you have to also calculate the required YTM of the new investor. The new investor is going to purchase this bond at 897. The new investor is going to purchase this bond for 897. So how much would be the yield for the new investor, and what is the relationship between the price of the bond and YTM? Okay. So one by one we'll solve. These are the factors given to you. At any stage you can ask query. Okay. Question number 1 from the revision notes. So first what we'll do? First we'll solve part 1, which is computation of market price, duration and volatility of the bond. So dear students, please follow me. This video lecture will be there in the app also after the lecture. In case if you miss something, or if you have missed something, you can check it there. Write down calculation of market price, duration and volatility of the bond. Draw this table first. Year, cash flow, PV factor at 9%, which is the YTM, present value, and year into present value. Okay. The question has 1000 rupees face value and 6.75% coupon rate. First 6 years, year 1, 2, 3, 4, 5, 6, year 1, 2, 3, 4, 5, 6, the investor will get a coupon of 1000 into 6.75%, that is 67.5. So write down 67.5 6 times. And in the last year, he will get 67.50 the coupon, plus he will also get the redemption 1050. The total amount he will get is 1117.50. Now I will ask you to do the remaining calculation. For calculating the intrinsic value of the bond, we will take present value, and for calculation of duration of the bond, we will multiply year into present value. I hope you have done this. Okay. So write down factor 1 divided by 1.09, 0.917, then multiply by 67.50, you will get 61.898, right? And then 61.898 multiplied by 1, same figure, 61.898. Factor is printed in the question book. So in question you will see the factors. Just copy the factor from there, 0.842 for second year. You can copy the factor from there and multiply by 67.50. Very good, Akshay. 56.835 and multiply by 2, 113.67. Factor for year 3 is given 0.772. Yes, Akshay, continue. Multiply 52.110. With the class you will also learn presentation, you will also learn the speed, and into 3, 156.33. Everybody should reply. Year 4 factor is given in question 0.708. Those who don't have the question, please download it from website vino.in. $47.790, 191.16. One student has asked a query, can we directly use annuity? The answer is only if you have to compute present value. But if you have to compute duration also, then you cannot use annuity factor. For duration calculation, we require present value of each year because I have to multiply by year. So please continue with the factors given in the book. Please continue. Please also reply everybody. I will be very happy. 0.596, 6th year. Check the answer if you have done. 7th year factor is given 0.547. Multiply and multiply by 7 and multiply by 7. Now what you do, those who have done, take the total of this column, that will give you the present value of the bond or the current price of the bond that should be there, or what is called intrinsic value of the bond. And then you take the total of this last column also. This will be required for duration calculation. So one student has given the total of present value column 914. Very good, Akshay Agarwal. And anybody for the last column total? Last column total. Last column total. Approximately you are getting 5274. Yes, very good. One student has confirmed 5274. So this will be required for duration. The formula for duration is the summation of year into present value divided by present value. So that will help you to get duration also. So now write down below the table, please write down. Rishabh is saying total of the last column is 5262. Let me check. 5274. Yes, that is okay. That small difference is okay. Rounding of difference is always okay. So price of the bond. Your first question was what is market price of the bond? The market price of the bond is 914.011. And the duration of the bond is equal to, now in the exam the students lose mark because they don't write the formula properly. To get full marks, first write the formula, then write the answer. Formula is summation of year into present value divided by summation of present value. So that is, take the total of your last column 5274. Some students have got 5262. You can take that, no problem. Divide by 914.011. 914.011. So the answer comes to 5.77. 5.77. One student, Rishabh, has got 5.76. That is also okay. So what is the meaning of duration? It is the average time required to recover the investment. Okay. From the duration we get what is called modified duration or volatility of the bond. So please write down our next answer. What is the volatility of the bond? Write down. Everybody please reply. Volatility of the bond. That is modified duration is equal to, first write formula, duration upon 1 plus YTM. Duration upon 1 plus YTM. Duration upon 1 plus YTM. Write nicely. One day you have to revise also. Quickly, one day before the exam, I have found best of the lot questions for you. So duration formula, Sidana has given correct answer, duration upon 1 plus YTM. Give me the final answer now. Give me the final answer. 5.77 divided by 1.09. 5.77 divided by 1.09. So that comes to 5.28. 5.29 is also okay. 5.28, 5.29 is also okay. Students who are in Pune can come and attend the classes in our Prestige Point, first floor. Now there is another question number 2. what is the required YTM of the new investor? So write down required YTM of the new investor. This you can solve by applying the formula. The formula for YTM in case of a coupon bond. The formula for YTM in case of a coupon bond is equal to C plus RV minus CP, C plus RV minus CP divided by N upon RV minus CP by 2, plus CP by 2, RV plus CP by 2, RV plus CP by 2. RV plus CP by 2. I'll just start again. New investor. You have to look at the YTM from the point of view of the new investor. New investor is going to invest 897 rupees in this bond, correct? So for him, the amount he is going to invest is 1897. Please solve. Let me see who will give me the answer first. Yes, come on. Reply. Who will give me the answer first? Yes, Manan, please reply. Rishabh, please reply. Mehul, please reply. Anybody got the answer for this? So the answer is 9.18%. 9.18%. Approximately write down. 9.18% approximately. When you are using the formula method, you get approximate answer. You do not get 100% accurate answer. In order to get accurate answer, we can solve it by interpolation formula or IRR method. So one student is requesting, let us solve by IRR method. So suppose you don't remember the formula, then you can solve the rate of return using IRR formula. So please write down. Alternatively, required yield of new investor using interpolation formula. Mehul Garg got it right. 9.178% is also okay. Now we'll try by one more method. This formula can be used only for coupon bonds. Formula can be used only for coupon bonds. But this IRR method can be used for any type of question. So write down 4 columns: year, cash flow, PV factor at 9%, PV factor at 10%. Year 1-7. Now you can use annuity because my objective is only to find out IRR. If you have to calculate duration, then you have to write separately. Cash flow for first 7 years would be 67.50, that is coupon. At 9% annuity factor, first you have to take on your calculator annuity factor. then multiply by 67.50. Annuity factor multiplied by 67.50. You will get 339.72. Correct? Yes. Then you take annuity factor for 7 year and 10% multiplied by 67.50. So one student has got the answer at 10%, 328.62. Year 7 write down redemption 1050. Year 7 redemption is 1050. 1050. 7th year factor, take on calculator 7th year factor, 1 divided by 1.09, press equal to 9 equal to 7 times and then into 1050. You will get 574.39. Check. Follow the discipline. Do it yourself. Do not copy. And at 10%, try 10%. 10%, what is the answer? 538.65. Rishabh got it right. 538.65. You can write 538.82 or 65. Now please tell me the total 9%. At 9%, the total is 914.11 approximately. At 10%, the total is 867.44. Rishabh got it right. Very good. And how much amount he has invested? 897. So now you apply IRR method and get the answer. So the answer would be YTM is equal to, YTM will be equal to 9 plus, in the numerator take the difference between 914.11 minus the amount invested by the investor 897, and in the denominator take the difference between the two present values. Take the difference between the two present values. This is one way to calculate IRR. Anybody who would want to reply? Anybody wants to reply? Yes. So many students have got the answer now. 9.37 or 9.36%. Right? 9.36 is also okay. 9.37 is also okay. So this is called YTM using interpolation formula, and this is called YTM using formula method, but it has limited applicability. It cannot be applied. The formula cannot be applied for every type of bond. Now there is the last line. What is the relationship between price of the bond and YTM? So I will dictate, please write down. I will dictate, you will write down. Which method we should use in the exam? For a coupon bond, you can use this method, no problem, unless you are more comfortable with YTM. But for other questions, if it is not a coupon bond, then you can find out the YTM using interpolation only. Write down one line. Write down one line. Mehul, write down one line. There is an inverse relationship between bond price and YTM. There is inverse relationship between bond price and YTM. Mehul has got 9.67%. I think you need to just check your calculation again. it should be close to 9.37%. We'll go to next question number 2. This question was asked in November 18 exam, May 14 exam, RTP November 2021. This question is on convertible bond, and we are going to discuss various terms associated with convertible bond, right? And very easy question if you know the concept of convertible bond and the various terms used in connection with convertible bond. Question can be asked for up to 8 marks. Already asked. Now, the following data is related to 9% fully convertible. So 9% is the coupon rate, fully convertible into equity share debenture issued by Delta Limited at rupees 1000. 1000 is the face value. Market price of 9% debenture is 1000 and face value is also 1000. Conversion ratio is 25. One debenture will be converted into 25 equity share. Straight value of debenture is 800. Straight value of debenture means if there was no conversion option, that means there was no conversion feature, it was a plain bond without any additional feature, how much would the price be? In that case the price would be 800, but because it has a conversion feature, the price is actually 1000. Then market price of equity share on the date of conversion, the market price of the equity share is 30 rupees. Then expected dividend per share is rupees 1. Expected dividend is rupees 1. Now you have to compute following 7 items, and I think you will get 1 mark for each correct answer. First is conversion value of debenture, market conversion price. Market conversion price, write down, it is also called conversion parity price. Write in bracket, or I think I have already written for you. Then conversion premium per share. How much premium per share you are giving? Ratio of conversion premium, premium over straight value of debenture, favorable income differential per share, and premium payback period. So we'll solve one by one and I will explain it also. So with this you will have a good practice of convertible debenture or convertible bond, highly tested in the exam. So are you ready? Say yes. Everybody who is watching live telecast, they should say yes 3 times S after YE. Okay, so start. First write down, first answer write down, conversion value of debenture. Conversion value of debenture. That means if the debentures are converted into shares, what is their value in terms of market price? Yes, Ganesh, thank you. Yes. Mehul, yes. Rajesh Jain, yes. So please give me the answer now. Market price of one equity share is 30. Conversion ratio is 25. So Rishabh has already answered 750. Is right, 750? So you will get 1 mark for this much effort. Darshana is also right, 750. Okay, try this one. Second answer, market conversion price. This question is very important, you will get in your exam. Market conversion price. Market conversion price. Market conversion price is also called conversion parity price, which is equal to the market price of convertible debenture market price of convertible debenture, market price of convertible debenture divide by conversion ratio. In the exam, first write formula, then write figures, then write answer. Minimum 3 steps you have to dedicate. Some students directly write the answer, then they might lose marks. So now you put the values. The market price of debenture is 1000, conversion ratio is 25, which means the conversion parity price is rupees 40. It is as good as paying 40 rupees for one share today. It is as good as paying 40 rupees for one share today. Sidana is right. Come on, next. Third answer, write down. Conversion premium per share. Conversion premium per share. Conversion premium per share means how much excess you are paying per share. How much excess you are paying per share. This question was there in November 2022 exam also. As I said, this question is very important. This was in November 22 exam also. Write down there, November 22 exam. Students who don't have the question paper will download it from website Vinod.in. This batch will be in English. So what is the answer here? Conversion premium per share. Is it 10 rupees? Yes. You can solve it by one more formula. Write down alternatively. I will give you both, then whichever one you are comfortable, you can follow it. So write down alternatively. Conversion premium per share is equal to market conversion price minus market price of equity share. Market conversion price minus market price of equity share. Okay. So market conversion price was 40 minus 30. The answer is 10. You can use any of the two formulae. Don't solve by both because you don't have time in the exam. Now what is your next question? Ratio of conversion premium. Ratio of conversion premium. Ratio of conversion premium is in percentage term how much more percentage you are paying over the conversion value. You could have directly purchased 25 share, right? But you have not purchased 25 share, you have purchased one debenture and for that you paid 1000 rupees. So how much excess percentage you are paying? Right. Bond price minus conversion value upon conversion value. Jaju is right. Try. Give me the answer before I show you the presentation. First you will try. This is revision batch. You already know this answer. You have done in class also. So 1000 minus 750 divided by 750 into 100 into 100. So that is 33.33%. 33.33% is right. Jan is right. Sidana is right. One more. Premium over straight value of debenture. Premium over straight value of debenture. This you will answer in percentage. You are paying 1000 rupees, but a similar bond without conversion feature is available for 800 rupees. So you are paying 200 rupees more. You are paying 200 rupees more over and above on 800 rupees. So you have to express in percentage, right? Always write three things in such cases: formula, calculation, and the answer. So the formula is market price of convertible debenture, market price of convertible debenture minus straight value of bond, minus straight value of bond, divide by straight value of bond, and you will get 25%. You'll get 25%. Is the answer 25% right? Please confirm. Yes, 25% is right. Next answer. Rajesh Jain is right. Rishabh is right. Favorable income differential per share. Favorable income differential per share. Favorable income differential per share. Next heading, write down favorable income differential per share. Favorable income differential per share, the formula is coupon interest from debenture. Coupon interest from debenture, how much interest you are earning from debenture minus how much dividend you would have earned from the share. Okay, that is favorable income. You have purchased the debenture, not a share. So how much extra you are getting, how much extra cash flow you are getting. Solve, divided by conversion ratio. So the logic is that by buying a debenture, how much additional cash flow you are generating, income you are generating per share. So how much coupon you will get from this bond? 9% of 1000, 90 rupees. How much dividend you will get if you are going to buy the share? You will get 25 share into 1, that is 25 rupees. So you are actually getting 65 rupees more by buying a debenture. Divide by 25. What is the final answer? Rupees 2.60. Rupees 2.60 is your favorable income differential per share. You are getting 2.60 per share more by buying a debenture instead of share. And one last answer, premium payback period. One last answer, write down premium payback period. Premium payback period. Come on. Premium payback period means in how many months or year the premium that you had paid would be recovered. Is it right? From that income differential. So how much premium per share you have paid? In your earlier calculation, third question fee, 10 rupees you have paid premium. And how much is your favorable income differential? 2.60. So to recover that premium, conversion premium that you have paid for buying the debenture, approximately how many years it will take? 10 divided by 2.6. Is it 3.85 years? 3.85 years. So write down lower the better. Okay. This is your answer of this question. This was a question on convertible bond. So we have taken a coupon bond, we have taken a convertible bond. Now I am going to take, guess what I am going to take next. Question, which question? Question 3. But what is the importance of this question? It is based on callable bond. Yes, one student correctly guessed. We are going to take a question on buyback of a bond, callable bond, where the company has the right to call back the bond before the maturity. That is called callable bond. Okay. Why will a company want to call back the bond? When they had issued the original bond, the interest rate was very high. But after some years, the interest rate may have gone down. So now they can call back the old bond and issue the new bond at a lower interest rate, and they can save interest for the remaining period. Okay, sometimes the company may not need a fund. So why to keep on paying interest when you don't need the fund? Is it right? So in that case, it will be better to call back the bond. Or suppose my friend Adani ji has too much of debt. They want to reduce their debt in the balance sheet. So they can call back the bond, and this way the debt can be reduced. But usually the question in the exam is, should we call back the old bond and issue the new bond? That is a typical exam question. Should we call back the old bond and issue the new bond? So that will involve lot of calculation. There will be some cost associated with calling back the old bond, and there are some benefit associated with calling back the old bond. So what will be the cost of calling back the old bond? You have to pay premium on old bond, because that is the condition that in case if the company calls back the bond, they will have to pay call premium over and above face value. They will have to pay some amount. Secondly, they will have to again incur the flotation cost. They will again incur the flotation cost of the new bond. Sometimes there can be overlapping interest. What is overlapping interest? That is, you are paying interest on old bond and you will also pay interest on new bond for some months, because you cannot exactly synchronize the refund of the old bond and issue of the new bond. That is, you can't say on 1st March I will redeem also the old bond and I will issue also the new bond. So there may be some time gap, and therefore there is a overlapping interest. Plus there will be tax implication also. So tax implication would be on call premium, flotation cost. If the bonds are issued at a discount, then on discount also there will be tax implication. You will save interest on that, you have tax payment. So all this will be considered, and then we'll take a decision whether to redeem the old bond or not. Understood? So what we will do, we will basically calculate NPV of the redemption decision, and as usual, if NPV is positive, then accept the decision to refund the old bond, and if NPV is negative, then reject the decision to refund the old bond. So depending upon numbers, the answer can be refund the old bond or continue with the old bond. Only on pure financial ground we have to answer this question. Okay, without getting emotionally attached with anything, just do the calculation and answer. So I will read the question, write it. Very important, very important question. Again, expect in the coming exam this question. Messrs Trans India Limited is contemplating calling rupees 3 crore of 30 years rupees 1000 bond one second. 3 crore is the face value. Original bond was issued for 30 years, rupees 1000 bond. So 3 crore divided by rupees 1000. Can you calculate how many bonds were issued? How many bonds? Number of bonds. 30,000 bonds were issued. For some calculation, I will need this number. So remember everybody, 30,000 bonds were issued, and it was issued 5 years ago. So 30 minus 5, how many years are remaining now? 25 years. It's called remaining maturity, and the original bond was issued at a coupon rate of 14%. Okay. The bond have a call price of rupees 1140. This is 1140. Now understand, you are going to pay 1140 per bond. Face value is 1000 rupees. 140 is called call premium. 140 multiplied by 30,000. 140 multiplied by 30,000. So 42 lakh rupees call premium you have to pay today. Okay, the bond had a call price of 1140 and had initially collected proceed of rupees 2.91 crore due to a discount of 30 rupees per bond. So this original bond was issued at a discount, which means they are amortizing the discount. So total discount given was 3 crore minus 2.91 crore. Please help me. What was the total discount given? 0.09 crore, which is 9 lakh rupees. Yes or no? Divide by 30 years. So they are amortizing every year how much? 9 lakh divided by 30,000. So 30,000 into 5 they have already amortized. But 30,000 into 25 is still to be amortized. So when you are going to redeem the old bond, you are going to write off this unamortized discount immediately. Correct? When the bond is not there, the related unamortized discount will not be there, it will be written off. So you will get the tax shield on unamortized discount today, but you will not get it in future. You will get it today, but you will not get it in future. So you are only accelerating the amortization of discount. So this will have a tax shield implication. Okay. Old bond was issued at a flotation cost of 3,60,000. Same discussion for flotation cost also. You will today amortize the remaining flotation cost balance. Sir, how much is remaining flotation cost balance? 3,60,000 is original amount. Divide by 30 years. So can you calculate and give me the answer? 12,000 into 5. 60,000 already amortized. And 12,000 into 25. That is how much? 3 lakh rupees is unamortized. This we will amortize today on the date of refund of the old bond. Very good, Rishabh. 3 lakh is right. Next line. The company intends to sell rupees 3 crore. So this is a new bond having same 3 crore rupees value of 12% coupon rate. So they are going to save 2% coupon here, and it will be for remaining period, that is 25 years. It proposes to sell the new bond at par value. So good news is that the new bond will be issued at par. So no discount on the new bond. So new bond does not have discount related adjustment. The flotation cost will be 4 lakh. So 4 lakh divided by 25 will be amortized. 16,000 rupees per annum will be amortized over 25 years. Cash flow will be incurred today, but the tax shield will be over remaining 25 years. Company is paying 40% tax. So wherever tax shield is involved, take 40%, and after tax cost of debt is 8%, which means this is the discount rate. This is the discount rate for all present value calculation. If the question gives you the discount rate, take it as a discount rate. Now as the new bonds must first be sold and their proceed then used to retire the old bond, the company expects a 2 months period of overlapping interest. Oh, so 2 months you have to pay interest on old bond at 14%. Overlapping interest means For first month and second month, you have to pay interest on old bond also, and you have to pay interest on new bond. So this is my cost. 2 months interest on old bond is also my cost. But interest is a tax deductible expenditure. So therefore, we will also consider tax shield on interest. Question is, what is the feasibility of refunding the bond? Got it? So I am going to do first two calculations. In year 0, what will be my cash flow? In next 25 years, what will be my cash flow? This I have to convert into present value by multiplying by PV annuity factor. And then the third step will be to find out the net present value. If NPV is positive, we will refund the old bond. So let us solve. I have explained everything. Please mark it very important question. Right. Step 1. Please write down step 1. Calculation of cash flow of year 0. Follow my instruction and you have to present your answer nicely in the exam. Calculation of cash flow of year 0. Calculation of cash flow of year 0. Calculation of cash flow of year 0. So write down. First write down point A. Call premium net of tax. Call premium net of tax. Point A, write down call premium net of tax. Call premium net of tax, you can understand 140 rupees per bond we are paying. 140 means 1140 minus 1000 into 30,000. And if you have to convert into after tax cash flow, multiply by 1 minus 0.40. Multiply by 1 minus 0.40. Give me the final answer. Are you getting 25 lakh 20,000? So this is your cash outflow. This is your cash outflow. Then write down B. Flotation cost of new bond. No calculation involved. 4 lakh rupees outflow. Given in the problem. Flotation cost of new bond 4 lakh rupees outflow. Flotation cost of new bond 4 lakh rupees outflow. Now remember, you have issued old bond at a discount of 9 lakh. For 5 years you have already taken the tax benefit. Remaining 25 years you have not taken tax benefit. But that unamortized balance will be written off now. So you will get the tax shield today on unamortized discount of old bond. Point number C, write down. Point number C, write down. Tax shield on unamortized discount of old bond. Tax shield on unamortized discount of old bond. So you will write 9 lakh into 25 by 30. 5 years are over. 25 years are remaining and the tax shield will be 40% of that amount. So this is positive cash flow. How much is that? 3 lakh rupees. Positive 3 lakh. Very good, Sidana. Write down next point. Similarly, the flotation cost of old bond. You have already redeemed the old bond. So unamortized flotation cost will be written off today. So please write point number D. Tax shield on unamortized flotation cost. Tax shield on unamortized flotation cost tax shield on unamortized flotation cost of old bond. Take 3,60,000 into 25 by 30 and that you multiply by 40%. Is it 1,20,000? Do you have any more outflow in year 0? Guess. Last paragraph, read and guess. You have overlapping interest for 2 months. So write down point number E. Point number E, post-tax interest on old bond, post-tax interest on old bond for overlapping period of 2 months. For overlapping period of 2 months. For overlapping period of 2 months. Write nicely. This is how you have to write in the exam. And that is where the student don't get full marks. They just write some kind of calculation. So I will explain the calculation now. 3 crore into 14%. Understood? Into 2 by 12 because only 2 months you have to pay. And I have to calculate after tax cost of interest. So I will multiply by 1 minus 0.4. Final answer is 4,20,000 negative. Let me check who will give me the total first. This is my year 0 cash flow. Come on, take total. Everybody. So total is 29,20,000 negative. 29,20,000 negative. Rishabh is right. Very good. This is my year 0 outflow, net cash outflow. Now we are going to compute the cash flow of next 25 years. Okay. And then convert that into present value. So are you ready? Write down step number 2, calculation of cash flow of year 1 to 25. Calculation of cash flow of year 1 to 25. Calculation of cash flow of year 1 to 25. Right hand side amount. Write nicely. I am also teaching you how you need to present in the exam. First point A, write down. Main reason for refund is interest saving. Okay. So always write first point as interest saved. Net of tax. If tax rate is given in the problem, interest saved net of tax. How much interest you will save on 3 crore? 2% you will save. Earlier you were paying 14%. Now you will be paying 12%. So 2% on 3 crore. But because you are going to save interest, you will not be able to save tax. Right? So there is a loss of tax shield. Loss of tax shield. So I will take into 1 minus 0.40. This is the after tax effect. 1 minus 0.40. Do the calculation. Every year you will save 3,60,000 net of tax. Very, very good. Then what are the other cash flows? Now remember, you have taken the tax shield on discount of old bond in year 0. You will not get for next 25 years. You have got the tax shield on unamortized flotation cost in year 0. You will not get in the next 25 years. Plus, you will get tax shield on the flotation cost of the new bond. So these are the 3 points we have to write now. Point B, loss of tax shield on discount of loss of tax shield on discount of old bond, loss of tax shield on discount of old bond. In old bond you have issued at 9 lakh rupees discount, divide by 30 years. So every year you are getting 30,000 rupees amortized into tax rate 40%. Into tax rate 40%. So how much tax benefit you will not get in future? 40% of 30,000 rupees. 40% of 30 every year. 12,000 rupees per annum. That should be 30 because per annum amortization is 30,000 rupees. If you want to take 25 year, then this figure has to change. No? This is old bond. For new bond, I will take 25. Okay, you are right, but that is for new bond. Same way, write down. Same way, write down loss of tax shield on flotation cost of old bond. Loss of tax shield on flotation cost of old bond. Right, 3,60,000 divide by 30 into 40%. So the answer is 4,800. Earlier you were getting every year 12,000 into 40% as tax shield, but that we have already considered in year 0. So you would lose in the next 25 years. So 4,800. And there is one advantage of issuing new bond. You will get the tax shield on the flotation cost of the new bond. Very good. Right. Tax shield on flotation cost of new bond. 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 So that will be 4 lakh rupees divided by, this is 25 year now. Your query is resolved. Why we have taken 25? New bond has 25 year life into 40%. So this is our benefit. So positive number. Tell me the total of this. Anybody for total of this amount column? 349,600. So this is my per annum benefit. This you will get for how many years? 25 years. Every year it becomes an annuity. So by multiplying by annuity factor, we will get the PV of saving, PV of benefit. So write down my step number 3, which is NPV calculation. So this is a very good presentation, and if you write like this, you will get full marks. Calculation of NPV. Right hand side amount. Calculation of NPV. So dear students, first write down PV of saving. PV of savings. PV of savings. PV of saving will be annual saving into PV annuity factor. Annual saving into PV annuity factor. 8% comma 25 years. So take on your calculator annuity factor for 8% and 25 years and multiply by 3,49,600. Are you getting something close to 3731980? 3731980? 3731980. Got it? Now just compute the outflow which we have already done. Point B, less cash outflow in year 0. less cash outflow in year 0. Everybody, what was the answer? Step 1 answer 29,20,000. Amazing. So now you write down the last line, point C, NPV. Write nicely. Presentation is also important. Only when you are running short of time, then do directly. 811,980. Positive or negative? Positive. 811,980 positive. So what will be your decision? What will be your decision? We will refund the old bond and issue the new bond. So write down the conclusion. Decision. Decision, write down. Refund the old bond. Refund the old bond. Refund the old bond. Okay. So that was a very important question on callable bond. We have covered most of the adjustment in this one example only. If tax is not given in the problem, then no adjustment relating to tax will be required. Now we'll take another highly important question on interest rate immunization. So another topic is interest rate immunization. Immunization means the change in the interest rate will not affect the return of the investor. Okay. Let us read the problem and I will explain it again. Are you ready? Everybody please say yes. Those who are studying online, please write yes 3 times. Yes, yes, yes. Then I will understand that yes, you are listening to me. Question is from November 18 exam. It was, I think, for 8 or 10 marks. Rajesh is yes. Rishabh yes. Mehul yes. Subhash Arora yes. Very good. I am glad. So one more question we'll take today, that is question number 4, and then we'll continue tomorrow after this question at 9:30. Please keep the printout ready. You can get the printout on website vino.in, www.vino.in. Naveen is saying yes, Priyanka is saying yes, and also please tell me whether you are enjoying this or not. Okay. Today was the first day, so there was some technical issue at the beginning, but now we have understood what are the problem that can arise. Naveen, Priyanka, very good. So you are enjoying this lecture. The following data are available for 3 bonds A, B, C. These bonds are used by a bond portfolio manager to fund an outflow scheduled in 6 years. So underline this. When are you supposed to pay a liability? You are supposed to pay some liability by redeeming this bond after 6 years. So we will say duration of liability is 6 years. Duration of liability is 6 years. Current yield is 9%. All bonds have face value of ₹100 each and will also be redeemed at par. So first you write down this question as very important for coming exam. Suraj is also saying yes sir, I am enjoying. Very good. When you are enjoying, I am enjoying. Interest is payable annually and this motivates us to put more effort. So there are 3 bonds. There are 3 bonds. Bond A, B, C. These are their maturity years and these are the respective coupon rates. First question is a bonus mark. Duration of each bond. Second question is the bond portfolio manager has been asked to keep 45% of the portfolio in bond A. So you are given a weightage of 45% for A and you have to also compute for B and C. Calculate the percentage amount to be invested in bond B and C that needs to be purchased to immunize the portfolio. Understood? So we have to ensure that duration of the asset should be equal to duration of liability should be equal to 6 years. So we'll have to solve a simple equation and find out the weightage of bond B and bond C. After the portfolio has been formulated, the interest rate change occurs, increasing the yield to 11%. So what has happened? The market rate of return has changed. It has become 11%. Because of this, the new duration of these bonds are bond A 7.15, bond B 6.03 and bond C 4.27. So these are the durations they have already calculated for you. Say thank you sir, thank you institute. Otherwise they can ask you to again calculate, and for 3 hours you will just do the duration calculation. Is the portfolio still immunized? Why or why not? So you have to recalculate the duration of portfolio. Okay, you have to recalculate the duration of portfolio using revised figure, and if it is equal to 6, you will say portfolio is immunized. If it is not equal to 6, you will say portfolio is not immunized. Next is determine the new percentage of B and C bonds that are needed to immunize the portfolio, bond A remaining at 45% of the portfolio. So this question and this question is same, only you have to use different data for solving that problem. Is it right? So how do you compute the duration? There are two ways you can compute the duration. One is by using the formula we have used in the first problem. Second is by a formula method. Directly apply the formula and you will get the answer. So this time I am going to solve it by another method which you will like it. If you understand, you can do faster. This is for time saving exercise. So learned student, please write down, first write down bond A. Bond A. Bond A, write down. First we'll compute present value. Present value of bond A is equal to, what is the coupon rate of bond A? 10%. Can you see 10%? 10% of 100 rupees 10 and multiplied by the current yield is 9% given. So 9% will be the discount rate. 10 year is the maturity plus 100 rupees face value into PV factor 9%, which is the YTM today, and 10 year. Solve. Kindly solve and find out the present value. Kindly solve and find out the present value of the bond. So that is 10 into 6.4176 plus 100 into 0.42241. Yes, please reply. What is the final answer? The student can trust me with the factor and you can go ahead. Anybody final answer? The final answer is 106.417. Please write it down, you can check later. 106.417. Then you write down current yield. The current yield formula is annual coupon upon current market price. Annual coupon upon current market price. Current yield formula is annual coupon upon current market price. Annual coupon upon current market price. 10 rupees coupon 106.42. Mehul Garg is right. Rajesh Jain is also right. Is 9.40%. Now write down the formula of duration directly. This is the formula you can apply for a coupon bond. Formula is current yield upon YTM, current yield upon YTM upon current yield upon YTM into PV annuity factor bracket YTM comma N upon into 1 plus YTM plus in bracket 1 minus current yield upon YTM into N. Ready? Put the values. How do you put the values? Current yield is this 9.4, write down. YTM is 9% given in the problem. In the question there is a small drafting mistake. Current yield is 9% written. It should be YTM is 9%. It should be YTM is 9%. Into PV annuity factor 9% comma 10 year into 1 plus 0.09 plus 1 minus 9.4 divided by 9 into 10. Just try yourself. Try. $1.0444. Annuity factor we have already calculated, so don't waste time. 6.4176 again into 1.09 plus in bracket 1 minus same 1.0444 into 10. So that gives me final answer 6.82 years. Okay. If suppose you find this is difficult, then you can follow the earlier method. Summation PV into year upon summation PV. Both will give you same answer. Is the answer right? 6.82 years. Okay. Say yes or no. Okay, now you write down bond B. Bond B, same process will follow. In bond B, write down next line bond B, present value is equal to now here the coupon rate is 11%. So 11% of 100 will be 11. 11% of 100 will be 11 into PV annuity factor bracket 9% comma 8 years. It has 8-year maturity. 9% is the YTM plus 100 into PV annuity factor 9% comma 8. Solve. Just write it down, later on you can check. 111.0698. Okay. Write it down, later on you can check. Yes. Now write down below that current yield. Current yield is equal to 11 rupees. What is 11? Coupon. And current market price, the previous answer, is 9.9%. 9.9%. Now write down duration. Don't write the formula again. In one answer write formula only once. Put the values now. Duration equal to 9.9 divided by 9 into PV annuity factor 9% comma 8 years into 1 plus 0.09 plus in bracket 1 minus 9.9 upon 9 into 8 into 8. Solve. Write down the answer 5.84 years. Later on you can check 5.84 years. Is it right? 5.84 years. 5.84 years. Now I will tell you one more thing before I go to bond C. If suppose the coupon rate is 9% and YTM is also 9%, what happens? The price of the bond is equal to face value of the bond, correct? If coupon rate and YTM are same, the price of the bond will be equal to face value of the bond. So if you look at the third bond C, the coupon rate is 9% and YTM is also 9%. So therefore there is no need to calculate. The price of the bond will be equal to 100 rupees only. And in case if price and face value are same, the current yield and YTM will also be same. Current yield will be 9 divided by 100. Current yield will be 9%. YTM is already 9%. So this portion becomes 1. This portion becomes 1. So this entire portion will become 0 because 1 minus 1. So duration will be only equal to this much. So that will save your time for the third bond if you know this basic thing, that if coupon rate and YTM are same, price is equal to face value and current yield is equal to YTM. So with that knowledge, we will go ahead, write down bond C. Rishabh is right. Intrinsic value is equal to face value. So bond C, write down. I am going to save your time. Coupon rate is equal to YTM. Bond is trading at par. The bond is trading at par. That is rupees 100. Write down. That is rupees 100. Then write down duration. Now I have given you the logic of this shortcut formula. Duration is equal to PV annuity factor, because current yield and YTM will be same, so the ratio will be 1. Solve. PV annuity factor 9% comma 5 year into 1 plus 0.09. Give me the answer now. One person has already answered. 4.24 years. Rishabh Sidana is right. Anybody else? Please. Is right. 4.24. 4.24 years is right. Okay. So we have computed the first part of this answer. There are 3 more parts. Due to some work, today we'll stop here and we are going to continue tomorrow at the same time, 9:30 AM. So thank you very much for joining me today, and I wish you will continue with this batch and you will get very important questions. Thank you very much. We are going to end the session today. Hello, good morning friend. We are solving an important question on bond valuation. Question number 4. The first part of the question was calculate the duration of each bond. calculate the duration of each bond. So in that case, we have already done that calculation, first part, by applying the formula of duration. You can solve by tabular format also. Now we'll go to the second part of the question. What was the second part of the question? I'll read from the question paper. What was the second part of the question? It was to second part, the bond portfolio manager has been asked to keep 45% of the portfolio in bond A. So weight of bond A is defined. Calculate the percentage amount to be invested in bond B and C that needs to be purchased to immunize the portfolio. So this is a problem of immunization. In case of immunization, the duration of the liability should be equal to duration of the asset. So first point is, what is the duration of liability? So for that, read the first and second line of the question at the top. It says these bonds are used by a bond portfolio manager to fund an outflow scheduled in 6 years. So which means that the liability has a duration of 6 years. So the duration of the bond portfolio should also be 6 years. Second issue is, how do you calculate the duration of a bond portfolio? It is the weighted average duration. So second concept is, the duration of a portfolio of a bond is the weighted average duration. We want the portfolio duration should be 6. We are given the weight of portfolio A, bond A. So we have to find the weight of bond B and bond C. So if you say that portfolio bond A has a weightage of 0.45, B plus C will be how much? 0.55. So if you assume that A is 0.45, B is suppose X, C would be 0.55 minus X, and then we can solve an equation and find the value of X, and we'll find the value of weight of bond B and bond C. So start writing now. Percentage amount of investment required in bond B and bond C. Percentage amount of investment required in bond B and bond C. A very easy question. If you go well prepared in the exam, then amount invested in bond A is equal to amount invested in bond A is equal to 0.45. Amount invested in bond A is equal to 0.45, which is given in the problem. Next line, write down, hence amount invested in bond B, and C is equal to 1 minus 0.45. 1 minus 0.45 is equal to 0.55. Now write down below, let the weight of bond B be WB. 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 Okay. Below that, write down, therefore weight of bond C is equal to, therefore weight of bond C is equal to 0.55 0.55 minus WB. 0.55 minus WB. Just wait a minute. Is right? Are you able to watch the video properly? Please reply yes or no. Student studying at home, is the video and the presentation understandable? Okay, so let us continue. Next line, write down, in order to immunize the portfolio, in order to immunize the portfolio, in order to immunize the portfolio, duration of asset is equal to, duration of asset is equal to duration of liability. Duration of asset equal to duration of liability. Duration of asset is equal to duration of liabilities. Now write one equation. The equation will be WA into DA. DA is duration of bond A. DA stands for duration of bond A, plus WB into DB. WB into DB plus WC into DC, plus WC into DC is equal to 6, is equal to 6. This is the equation, and now you write the figures below the equation. WA is 0.45 given in the problem, 0.45 into 6.86, which is the duration of bond A we have computed earlier, plus WB into 5.84 plus in bracket write 0.55 minus WB, that is weight of bond C, into 4.24 is equal to 6, is equal to 6, is equal to 6. Now please solve the equation. How did you get 6? 6 is given in the first second line. The duration of the liability is 6 years. Outflow is planned after 6 years. So we have to ensure that duration of the bond portfolio should also be 6 years. So who will give me the answer of WB? WB is the missing figure here. WB is the missing figure here. Anybody who got the answer for WB? Please solve. WB is coming to, Rishabh has got it right, 0.3631. You can write 0.36 also. 0.36 also you can write. And then you will calculate WC. WC is equal to, come on, WC is equal to 0.55 minus 0.3631. So Prachi Kothari is also right, 0.36. WC Rishabh is right, 0.1869, or you can write 0.19. 2 digits are also okay. 2 digits are also okay. Kothari is also right. So this is the answer of second part. Agreed? Now we'll go to the third part. Write down answer part 3. Answer of part 3. Answer of part 3. Everybody should reply. I will read the question part 3 again. Just they have changed the data. After the portfolio has been formulated, an interest rate change occurs. Okay. So after the formula, this weight you have assigned, market interest rate has changed, increasing the yield to 11%. So YTM has changed. The YTM will change, the duration will change. So they have themselves done the calculation of new duration. The new duration of these bonds are A 7.15, B 6.03 and C is 4.27. Is the portfolio still immunized? Is the portfolio still immunized? Why or why not? So what you should do now, you should calculate the duration of this portfolio again based on revised duration. Weights you have computed, and if it is equal to 6, then we will say it is still immunized, and if it is not equal to 6, then we will say it is not immunized. Is it right? So write down the answer part 3. Write down the heading calculation of revised portfolio duration. Calculation of revised portfolio duration with revised yield. Calculation of revised portfolio duration with revised yield. Weights we have computed, duration they have given. So write down below is equal to 0.45 into 7.15, that is your weight of bond A and the revised duration of bond A, plus 0.3631 into 6.03, that is revised duration of bond B, plus 0.1869 into 4.27, that is revised duration of bond C. I would want student should give me the answer. Student should give me the answer. What is the revised portfolio duration? So one student has said 6.20. Let me check. Yes, you're right. Amazing. Sidana got it right. Prachi got it right. 6.20. Okay. But duration of the liability is 6 years. Duration of this bond portfolio is 6.20. So my question is the portfolio still immunized? So you will write a note. Write a note below. No. Portfolio is not immunized. Portfolio is not immunized. Portfolio is not immunized. As the duration of the portfolio has been increased from Mehul Garg is also right. 6.21 is also okay. Has increased from 6 years to 6.21 years. Has increased from 6 years to 6.21 years. This was your answer of the third part. Fourth part is determine the new percentage of bond B and bond C that are needed to immunize the portfolio, bond A remaining at 45% of the portfolio. So what they have done here, they have just asked you to revise the weights based on revised duration. Am I right? Weight of bond A is still 0.45, You have to find the weight of other two bonds with the new duration. So write down answer of part 4. Answer of part 4. Answer of part 4, we have to solve it like second part only. Keep the question in front of you. This question paper can be downloaded from our website vinod.in. You will find in the resource section, free resource section, these notes. You can download and take a printout. So write down new percentage of B and C bonds, new percentage of B and C bonds that are needed to immunize the portfolio. It's a lengthy question but easy question. So I am going to write the equation again. Same equation, WADA plus WBDB plus WCDC is equal to 6. Solve. WA is 0.45, which is given in the problem. Revised duration of bond A is 7.15 plus WB into 6.03 plus in bracket 0.55 minus WB into 4.27, and that is equal to 6. Let us say who will give me the answer first. Solve for WB. Student will have to solve. Then only I will be able to understand that yes, you are learning. Anybody wants to reply for weight of bond B? Weight of bond B is 0.246. Very good, amazing. Weight of bond B is 0.246. Very good. Now tell me weight of bond C. Take 0.55 minus 0.246. Very good. 0.3034. 0.3034 is right. 0.3034 is right. But later on, do we need to write the whole formula again? There is no need to write the formula again. The good question is, you can just remove this line. This is what your query. You can remove it. This line is not actually required. You are right. Just for discussion purpose, I have brought it again. Okay. So this answer finally is over. It was a good question. You can get full marks by solving like this. So today we will take one more question. Prachi is also right. Question number 5. Question number 5 is based on forward rates. Question number 5 is based on forward rates. So these are the different varieties I have taken in the revision batch. Question number 5 in front of you. Below is a list of prices of zero coupon bond of various maturities issued by a company. So these are zero coupon bond. Zero coupon bond means no interest paid during the lifetime of the bond. The bond will be issued at a discount and redeemed at par. Okay, of various maturity. Year 1 maturity. Face value is 1000 rupees, but the price is 943.40. Maturity is 2 year. The price is 873.52. The maturity period is 3 year. The price is 816.37. Find the forward rates. So you have to find the forward rates. Is it right? What is forward rate? The rate that we expect will be prevailing in future. The rate that we expect will be prevailing in future. That will help us to sometimes take decisions. Sometimes it gives rise to arbitrage opportunity also. Okay. Now this is first basic question of forward rate. Second question is, suppose an 8.5%, this is your coupon rate, rupees 1000 face value, this is face value, 3-year maturity bond. So there is another bond which is a coupon paying bond which pays 8.5% coupon, 3-year maturity of a similar company is available in the market. What would be the appropriate price of this bond? What would be the appropriate price of this bond? So this answer can be found out by using the forward rates that we will calculate in the step number 1. Is it right? So how do you compute the forward rates? What will you do first? What will you do for computing forward rates? First step will be to find out YTM of each bond. Is it right? So write down step 1. Step 1. First we should calculate the yield of, zero coupon bond. Using the YTM of zero coupon bond, we are able to calculate the forward rate. Now tell me, I am going to ask you a question to check your understanding. First we will calculate the YTM of first bond whose maturity is 1 year. Price is 943.40 and face value is 1000 rupees. What will be the YTM of this bond? No, that 56.60 is the amount. We have to answer in percentage. So you divide by 943.40. Difference you divide by, yes. So the answer for the first bond, it seems, would be 6%. So write down the equation. First write down, we will solve following equation. In a zero coupon bond, all of you know, in a zero coupon bond, the price of the bond today is the present value of the face value or future cash flow. Future cash flow is only face value on redemption. Solve. So this equation you will use for all the three bonds. Price of ZCB is equal to face value upon 1 plus R to the power n. So now we'll first compute. Under that, write down calculation of R01. It means the YTM of 1 year bond today. Using 1 year bond, calculation of R01, spot rate for 1 year maturity. Is it right? R01 means spot rate for 1 year maturity. So you will take 943.40 is equal to 1000 divided by 1 plus R to the power 1. Solve it. Everybody please solve it. So you are getting 6%. You are getting 6%. Any way you present, your answer should be 6%. Any way you can present, your answer should be 6%. You can directly take the difference and divide by 943.40. That is also okay. For 1 year bond, you can solve by any method. Right? Now below that write down calculation of, next line, calculation of R02 using 2 year bond. Calculation of R02 using 2 year bond. Calculation of R02 using 2 year bond. Yes, please come on, reply. What will be the YTM of a 2 year zero coupon bond? So I will write the equation like this. Just wait a minute. I am just trying to make some correction in the presentation. Can you see the screen now? Hello students, can you see the presentation now? Can you see the presentation now? Okay. Sorry, there was some setting issue. So write down the answer now. 873.52 equal to 1000 divided by 1 plus R02 to the power 2. So this is the yield of a 2-year zero coupon bond. Solve. So how do you solve? So R02 will be equal to 1000 divided by 873.52 to the power 1 by 2 minus 1. Solve. First, to take on your calculator, this divide by this. Press the square root function for 1 by 2. Press the square root function for 1 by 2 minus 1. So how much is the answer here? Yes, Mehul Garg has given 7%. Very good. Now write down same calculation. Do little fast now. You have understood. Calculation of R03. Calculation of R03 using 3-year bond. Calculation of R03 using a 3-year bond. So here the equation would be like this. Present value is given in question 816.37 is equal to 1000 divided by 1 plus R03 to the power 3. 1 plus R03 to the power 3. Okay, these are basic things you have to know. And how do you solve this R03 equal to? Take 1000 divided by 816.37 to the power 1 by 3 minus 1. Third root you have to take. You have to take the third root. Yes, come on, this time it is a challenge. This is 7% only. Huh? How did you get 7%? Okay. So there is a trick on the calculator that first you type 1000 divided by 816.37. Okay. You will get some number. 1 point how much? 22. 2249 and 3333. This is the answer. Take square root of this number 12 times. 12 times. Then minus 1. Minus 1. Multiplied by 0.3333 plus 1. Multiply equal to 12 times. Multiply equal to 12 times. So how much is that? 1.07. So 1.07 minus 1.07. Therefore, the answer is 7%. So these are the YTMs. These are not forward rates. These are the YTMs. Now we will find out the forward rate, which is your first question. Write down step number 2. Step number 2. Step number 2 would be forward rates. Step number 2, write down forward rates. Write the formula for forward rates. Forward rate is equal to 1 plus YTM T to the power T upon 1 plus YTM T minus 1 to the power T minus 1 to the power T minus 1 and then minus 1. This formula you should know for forward rates. Okay, this formula will save a lot of time. Now for year 1, always forward rate and YTM will be same for year 1. So basically we have to do the calculation for second and third year. So write down one note below. Write down one note below. Note forward rate for first year. Forward rate for first year is same as YTM of 1 year bond. Is same as YTM of 1 year bond. Is same as YTM of 1 year bond. That is 6%. That is 6%. Same as YTM of 1 year bond, that is 6%. Okay. Now write down below that a small table will draw for year 2 and 3. Okay, right. Now draw one table. Draw one table. Draw one table. F12. F12 means forward rate for the second year. What will be interest rate after 1 year for a period of 1 year? What will be the interest rate after 1 year for a period of 1 year? So what will be the interest rate in the second year? So write the formula. Please write the formula. 1 plus 0.07 to the power 2, which is the YTM of second year, 0.07 divided by 1.06 minus 1. So this is approximately 8%. Okay, now I would require you to try the next one, F23. I want you to try F23 in the same manner. This is a revision batch. Students should be capable of solving. So F23, come on, F23. Those who don't have the notes can download it from the website. F23. Yes, come on. I am waiting for you. And you are also waiting for me. Who will blink first? So the answer is 7%. The answer is 7%. Very good, Rishabh. 7%. Is it right? You forgot the power. One student is saying he's forgetting the power. Don't forget the power. You don't know the power of the institute. Okay. Their power will push you down by 6 months. So this was the answer of forward rate. Now next question is, what is the price of a bond what is the price of a bond which pays a coupon of 8.5%, face value is 1000 and the maturity is 3 years. Using the forward rates we can find it out. Is it right? Or using the YTM we can find it out. So write down the next answer. Calculation of the price of the bond. Calculation of the price of the bond. We have got the forward rates for year 1, 2, 3, correct? So how do you calculate the price of the bond using forward rate? Write down price is equal to first year coupon will be 8.5% of 1000 rupees, 85, correct? And the first year forward rate or YTM is given 1.066%. So this is the present value of coupon of the first year. Now this is the present value of the coupon of the second year. Why we have taken like this? Understand, there are 3 years involved. 6% is the forward rate for this year. 8.009% is the forward rate for this year. So if you will get 85 rupees here, first you will discount by 8.009%. This amount you will discount by 6%. So you are discounting 1 year at a time. You are discounting 1 year at a time. So therefore we have to divide by, actually we are dividing first by this factor and then we are dividing by this factor. And the same thing for third year also. In the third year we will get 1000 face value plus 85 rupees coupon. And the third year forward rate was 7%. So you will first bring it to this point by 7%, bring it to this number by 8.009% and bring it to year today by 6%. So that is the answer. Please solve. Let us see who will solve it first. Let us say who will solve it first. Come on. Rates are different for every year. So we are basically pulling it down 1 year at a time. Yes. So if you get 1085 at the end of third year, the discount rate for this period is 7%. So we have taken 7%. Then you will get a present value at this point. To bring it to this point, you discount it by 8.009%. You got the value here. To bring it down to year 0 level, you discount it by 6%. So who got the answer? Anybody who got the answer? Check the final answer. This way, using forward rates, we can compute the price of a coupon bond also. So please reply if you can. What is the answer? What is the answer? Please reply. What is the answer? $1040.12. 1040.12 is right. So this is how you calculate the price of a bond given the forward rates. And how do you compute the forward rate? By using YTM. First you have to get the YTM of zero coupon bonds. Okay. If the rates were like different for first 2 years, then you could have taken a PGA for 2 years. Right? Yes, if the rate was same for first and second year. If the rate is same, you can apply the annuity factor. Okay. So this was bond valuation. we'll start with this next topic, valuation of shares. This topic is again important for exam. Question can be asked from 4 to 8 marks on this topic. So let us start with one November 2020 question for 8 marks. A little tricky question if you have not prepared well in advance. So I would highly recommend that you must prepare this question before you go to the exam. Question number 1. From November 2020 exam for 8 marks. An investor is considering to purchase the equity share of LX Limited, whose current market price is rupees 112. Current market price is given 112 rupees. Okay. The company is proposing a dividend of rupees 4 for the next year. Next year underline. So D1. Next year means dividend of year 1. Dividend of year 1. Now LX Limited is expected to grow at 20% per annum for the next 4 years. It is expected to grow at the rate of 20% per annum for the next 4 years. So every year the dividend will grow at the rate of 20% till 4th year, and then what will happen? The growth will decline linearly to 16% per annum after the first 4 years. So see, the growth rate will be, suppose I draw a line, the growth rate will be 20% for year 1, 2, 3, 4, and then it will decline every year. It will decline every year to 16%. From 20 it will become 16 over the next 4 years. Okay. So each year how much will be the decline? Each year how much will be the decline? Decline will be 1%. Decline will be 1%. So it means the growth rate will become 19, 18, 17, and then it will become 16, and it will remain at 16 forever. Then it will remain at 16 forever. Okay. Thereafter it will stabilize at 16% per annum infinitely. The investors requires a return of 20% per annum. So this is my discount rate. You are required to calculate the intrinsic value of the share of X Limited. That means present value of future cash flow. And then, is it worth to purchase the share at this price? So you have to compare with 112 rupees. Compare with 112 rupees and check whether you need to buy the shares or not. So what is the new concept in this question is that the growth rate will decline linearly to 16% per annum after the first 4 years. The growth rate will decline every year till it reaches 16%, and then it will stabilize at 16% per annum for infinite period. So you have to find intrinsic value and you have to find whether it is advisable to purchase the share or not. So how do I solve it? If you know the concept of this linear decline in the dividend rate, you can easily crack it. Linear means equal decline in each year. Equal decline in each year. So we will assume equal decline in each year means 1% decline in each year. So can we now solve by preparing a table? Say yes. Yes sir, very good. Write down calculation of intrinsic value of shares. Calculation of intrinsic value of shares. Now I hope the audio, video, presentation, everything is clear. So this is a question on multi-period growth model. This type of problem is called multi-period growth model, where growth rate is high in the initial years, slowly and slowly they start declining. So whether it is Microsoft company or Google company or Infosys, everybody has to go through this. First few years they are making super normal profit, then they give more dividend, but later on as the competition increases, no new innovation happens, the growth rate starts declining and then it becomes stable at a normal rate. So I am going to draw total 5 columns. First column write year, second column growth rate, third column dividend, fourth column PV factor at 20%, which is given in the problem. So respect the institute, they have given you the factor. And last column present value. So first you write down year 1. First write down year 1, growth rate 20%. But they have given year 1 dividend is 4 rupees. So don't further add 20%. It is already including growth of 20%. Read the first second line. The company is proposing a dividend of 4 for the next year. So some student might take 4 plus 20%. It is 4 only. Discounting factor printed in the question book. 0.833. Kindly multiply 3.33. 3.33. Now year 2 write down. Now you will add 20%. First, second, third, fourth. Growth rate is 20%. 20%. 4.80 factor type from the question book. 0.694 into 4.80, 3.331. Come on, next year 3, 20%. Add 20%. 4.80 plus 20%, 5.76, factor 0.579, multiply 3.335. Year 4 again 20%. Up to year 4, the growth rate will be 20%. The factor is given 0.482, multiply 3.332. Everybody should reply. Now wait. After year 4, the question says third line, growth will decline linearly. Growth will decline linearly. There may be a spelling mistake in the book. Linearly means by equal percentage. Linearly to 16%. So from 20 it will become 16 linearly, equally. So we will assume decline is by 1%. The question is not very clear on that. After the first 4 years, so it will become 19. So now your dividend will be previous dividend plus 19%. 8.225. Factor is given 0.402. Multiply. Kindly multiply 3.307. Right. Year 6, 18%. Take 8.225 plus 18%. You will get 9.706. Factor is given 0.335. Multiply 3.251. Very good. 7. Growth rate will be 17 now. Take the previous dividend plus 17%. 11.356. Factor is given 0.279. Come on, student, come on, multiply. 3.168. Now after that, from 8th year and onward, the growth rate will be 16%. So it will become a constant growth model formula. You remember constant growth model formula, D1 upon KE minus G. So that means we have to make a small working note for that. So from 8 till infinity, 8 to infinity, we will prepare a working note for that. The growth rate will be 16%. Now don't take this figure and plus 16. That will be only 8th year, but 9, 10, 11, 12 till infinity, the dividend will continue to grow at the rate of 16%. So it becomes a perpetuity. So I will have to apply a formula below. Write down below working note 1. Working note 1, write down terminal value in bracket P7. P7 means price of the share after 7th year. Price of the share at the end of 7th year. Price of the share at the end of 7th year. Okay. So how do you calculate it? P7 is equal to D8 upon KE minus G. D8 upon KE minus G. Come on. Dividend of the 8th year will be dividend of the 7th year into 1.16, 16% growth, divide by cost of equity is given in the problem 20% and the growth rate is given 16%. Yes, come on, Mehul, Rishabh, please reply. Priyanka, Prachi, please reply. Preeti, all students must reply the answer. Haji, how much is the answer? Final answer 329.324. Anybody for this? Approximately 329 you are getting? 0.32. Okay. Prachi is also right. Rishabh is also right. So write down that number in the main page now. Bring that number here. This is not dividend, but this is price at the end of 7th year. This is price at the end of 7th year. So which factor you will apply? 7th year factor or 8th year factor? Which year factor you will apply? 7th year factor or 8th year factor? Present value factor. 7th or 8th? This is not dividend. This is price at the end of 7th year. So I have to bring it to year 0. So the factor would be of 7th year. Same factor. Same factor. 7th year is right. Preeti is also right. Mehul is right. Multiply now. 91.880. Now I want to check who will give me the total first and correct. Start. Competition starts now. Everybody. There are some students in the classroom attending physical batch and there are number of students attending from home. So I want to see who will answer first, the physical class student or the online student. 114.94. Oh, physical class student got it right. Probably because of advantage of face to face. No internet lag. Maybe the students who are learning at home, there is a lag of 1 or 2 seconds. But they also got it right. Kothari got it right. Kabra got it right. Anandam got it right. Now the question was whether it is worthwhile to purchase the share. Market price is 112. Market price is 112. Intrinsic value is 114. You are getting the share cheaper. So tell me again, buy or not to buy? Buy or not to buy? Buy or not to buy? Muhevul is right. So what advice will you write? Should the investor buy the share or not? The answer is yes, buy, because it is cheaper. Yes, you have some query? Write down advice. That is a mistake. This is 114. 114.94. Right, 114.94. Everybody is saying buy the share because it is undervalued. Write down the note and then conclude the answer. The intrinsic value is rupees 114.94. Whereas the current market price is 112. Whereas the current market price is 112. Therefore, the stock is underpriced. Write nicely. Hence, it should be purchased. Hence, it should be purchased. Hence, it should be purchased. Yes, cost of equity means investors' required return, 20%. That is the discount rate investor will use to calculate the present value. So this answer is over. Question for 8 marks in the exam, bonus mark. Okay. So do the practice before you go to the exam. Looks easy once you solve. Now try question number 2. This is from July 21 exam for 5 marks. NM Limited is aspiring to enter the capital market in 3 years' time. NM, Narendra Modi Limited. Okay. Okay. We will not make more comments on that. The board wants to attain the target price of 70 for its share at the end of 3 years. So what is the target price after 3 years? 70 rupees. The target price is 70 rupees. The present value of the share is 52.03. What is the present value? 52.03. Dividend is expected to grow at a rate of 15% for the next 3 years. NML uses dividend growth model for its projection. The required rate of return is 15%. That is your cost of equity or discount rate. Very interesting question. You are required to calculate the amount of dividend to be declared by the board in the base year so as to achieve the target price. So they have given you the answer 52.03. This is P0. This is P3. D1, D2, D3 is not given. The student has to find D1. The student has to find D1. First chance to you. First chance to the student. Suppose you are appearing in this exam and this question appears for 5 marks. What would be the dividend of the base year, means first year, so as to achieve the target price? Yes, anybody wants to reply? Again you have to solve equation. Is it right? Yes, students are requested to answer. What will be the dividend to be declared by the board in the base year to achieve the target price? So D1 you have to find. You can assume D1 as X. This will be X into 1.15. This will be X into 1.15 square because the growth rate is 15%. And P3 is 70. So you will discount it and it should be equal to 52.03. So once after solving it, you will get the answer X, and that is your answer. I have given you enough hint. For discounting purpose, factors are given in the question. Come on, come on. Anybody? I hope all of you are awake, or have you gone into the sleep mode? Please reply. Check whether you are exam ready or not. Are you exam ready? If yes, answer this question. Nobody has answered till now. So I will give you the answer now, or if you have done in the same way, you can check. Let base year dividend be D0. Let base year dividend be D0. Let base year dividend be D0. Nowadays, the institute has started asking reverse question. They will ask you to find the base year dividend given the price of the share. So please write calculation of share price today like a normal question solve, and it will be equated with the price today 52.03, and that will give you the value of D0, and you can find the value of D1 also, correct? So first year dividend would be D0 into 1.15. D0 into 1.15. PV factor printed in the book 0.8696. Multiply, you will get, how do you multiply? 0.8696 into 1.15 will give you this number, and then write D0. Year 2 will be D0 into 1.15 square, factor is printed 0.7561, multiply, how much you are getting? 0.99994 D0 you are getting. Very good, those who are replying. One student has already answered, Geetika, she has answered 2. Let us check. Third year dividend will be D0 equal to 1.15 to the power 3, factor is given, and multiply 0.6575 into 1.15 to the power 3. You will get something like 0.99998. Why you are getting same answer? The reason is, on one hand you are increasing by 15%, on the other hand you are discounting also by 15%. So actually it should have been 1, 1, 1 in all the 3 years. Is it right? Because you are discounting and compounding by the same 15%. 70 rupees, third year price 70 is given. So that will also be discounted by 0.6575. Multiply, you will get 46.025. Take the total. First you add these three numbers which has D0. You can write 3D0 also. Okay. So it comes to 46.025 plus 3D0. If you want to write 3D0, it's okay. And this should be equal to what? This should be equal to 52.03. So write down equation share price today is equal to 46.025 plus 2.99996 D0, or just write down 3D0. Chidana has also replied, answer is 2. So your answer is right. Clap for all the students who have got it right. 2 rupees D0. So what will be D1? 2 into 1.15. Answer both. 2.30. So I don't know whether they want base year means D0 or D1. So I would prefer to write both the answer. Now they can't deduct marks. So this was a good question. One student has written also, nice question. Yes, all question in this book is nice only if you go to the exam with well preparation. One more practice will take, this time on buyback of share. Do you know buyback? Sorry, right share, not buyback, right share. Right share means company wants to raise additional funds by issuing equity share to existing equity shareholder. That is called right issue. Okay. Like recently, my close friend Adani had made a right issue of which company? Reply, Adani Enterprise. What was the amount? 20,000 rupees. Crore. 20,000 crore. Yes, that was like right issue only. FPO. Public was also invited. So it was, let us say, FPO. Okay. Reliance company had gone for right issue 3 years back. This issue was withdrawn. Anyway, I'll come back to my question. July 21 exam for 5 marks. I will tell you, this is also bonus mark if you are well prepared. Otherwise, you can make minor mistake. A Limited is proposing to fund its expansion plan of rupees 12 crore. So first you underline 12 crore by making a right issue. Share issued to existing shareholder. Current market price is 40. Board is willing to offer a discount of 20% on the current market price for the right issue. Understood? So what will be the subscription price? 40 minus 20%. Is it 32? So in order to motivate the existing investor to subscribe to the share, they will have to offer the share at a lower price. Board is also desirous that the fall in the ex-right price of the share be restricted to 10% of the current market price. So what is your ex-right price expected to be? 40 minus 10%. So ex-right price is 36 rupees. Calculate number of new equity share to be offered for each right held. Then theoretical value of the right and the total number of equity shares to be issued. Total number of equity share to be issued. So please solve first yourself. Number of new equity share to be offered for each right held. So what is the ratio they are asking you? What is the ratio of right issue? Whether it is 1:2, 1:4, 4:1, something like this. Geetika is right. Geetika, I don't know whether you are right or not, but she said the answer is 1:1. I have to check. Yes, anybody? Ratio. That is, what is the ratio of right issue? Because the number of share to be issued is printed separately. Number of share issued will be 12 crore rupees you want to raise, and you are going to offer at 32 rupees. So that may be a different easy question. This question requires right issue ratio. Right issue ratio. Because otherwise question 1 and 3 will become same. Right issue ratio. Come on. So anybody who got the answer? One student has only replied. Subscription price write down. Subscription price write down. Write in detail. We are doing two things. We are revising the syllabus, plus we are also learning the presentation skill for the exam. Okay. So first you should always write the heading, then the formula for calculation, then calculation 40 minus 20%, and then write the answer. So usually I suggest 3 lines minimum. You should write to calculate any answer. Then X right price. Again here write down current market price minus 10%, 40 minus 10%, 40 minus 10%. Okay, then you will get 36 rupees. Those who don't have the notes will download from our website vinod.in. You will find in the free resources section at the top. Now write down step 3. This was a tricky question. Only one student has answered till now. Calculation of ratio in which right shares are to be issued. Calculation of ratio in which right shares are to be issued. Do you remember the formula of X right price? This formula is taught in the class. This formula is also in EPS chapter also. In intermediate AS20, EPS, come right price, X right price, subscription price. So the formula is come right price into right ratio plus subscription price divided by right ratio plus 1. Divide by right ratio plus 1. This is the formula of basically weighted average rate. It's a formula of weighted average rate. So now you put the values. 36 is equal to 40 into X. 40 into X. X is the right ratio plus 32, which is the subscription price, divided by X plus 1. Divided by X plus 1. Now I hope you can solve. Come on, quickly. Students are not replying. Have you gone into sleep mode? The answer is 1. X is equal to 1. So 1:1 was the correct answer. Geetika Deena Karan was right. Okay, 1:1. So first if you get this right, you will get 2 marks. Then the next question is theoretical value of right. Theoretical value of right means, first write a note. Note, one right share to be issued for one existing share. Reserve is right. One right share to be issued for one existing share. Now next step, write down theoretical value of right. Theoretical value of right. That means if you want to sell this right to somebody else, how much you can sell it for? Anybody holding this right can buy the share for 32 rupees. And the market price after the right issue is over will be 36 rupees. So what is the worth of this right? The worth of one right will be equal to 36 minus 32. Now what is the mistake you can make here? You can take 40 minus 32. You can buy the share for 32 because the moment you buy the share, the market value of the share will go down to 36. So you should compare with 36. Because you will say, the buyer of the right will say, I will get a benefit of only 4 rupees. Why I will pay 8 rupees? Because the moment I apply for the share prices will go down to 36 rupees. So this right will have a worth of 4 rupees. Theoretical value. Practical it can be more than or less than that. We are in the classroom. Closed environment. So mathematically 4 should be the answer. Last question for this part 3. Part 3 of the question 3. Number of right share to be issued. Write down. Number of right share to be issued. Always present in a tabular format if you can. Or in good handwriting. First write down A, funds to be raised. Funds to be raised. Funds to be raised is 12 crore, rupees in crore. Subscription price is 32. This is the easiest question of this chapter. Then number of equity share to be issued, like a school question, 12 crore rupees you have to raise, share will be issued at 32, so you are going to issue how many shares? So write down 37,50,000 shares, 37.5 lakh you can write 0.375 crore, anything you want, you are welcome. Okay, there they will not deduct marks. If they deduct marks for rounding off, it is wrong, injustice to the student. Okay, now we'll take May 19 question. For marks I have not written, but it is around 8 mark question. Are you ready? This is another different variety of question. It was asked in exam and they repeat this question with different data. Okay, they will change the data. They will change the data in your exam and they will ask you the same question. So tell me, are you ready? Louder yes. Everybody should say yes. YESSS. Following financial information are available of XP Limited for the year 2018. So year is 2018. Equity share capital is 200 lakh. Reserve and surplus 600 lakh. Debenture 350 lakh. Now underline interest rate here 10%. So the interest is 35 lakh. Agreed. And the total of the asset side is 1200 lakh. Asset turnover ratio is 2. Do you know the formula of asset turnover ratio? Anybody wants to reply? Asset turnover ratio. Asset divided by turnover or turnover divided by asset? I am getting two answers. Asset divided by turnover or turnover divided by asset. What have you learnt in your ratio analysis chapter in that wonderful intermediate syllabus? So the formula is sales upon asset is 2 and asset sales upon assets 1200 is 2. So you can use this information to find sales figure. So basically they are testing your fundamental knowledge of the ratio analysis also. You can't take an excuse that I am not a student of intermediate anymore. So please do not give me such questions. They are hardly going to listen to you. Sales. Tax rate. So let me see student, those who are studying. Mehul said turnover by asset, Preeti, Rishabh also. Okay, so everybody said this ratio. You are right. Now 30%, then operating margin is 10%. If operating margin is 10%, which means operating cost will be 90% of sale. Yes or no? If operating margin is 10%, then operating cost will be 90% of sale. Sale is 2400. Operating cost will be 90% of 2400. That will give you operating profit. That will give you operating profit. From operating profit, you will deduct the interest. You will get earning before tax. You will deduct tax. You will get earning after tax. So indirectly, you have to prepare one small P&L account using the data. And then once you get the PAT, you can compute the dividend also. How much dividend they are going to pay? 20% of the earning, that is dividend payout ratio. Current market price is 28, required return 18%. This is discount rate. Okay. Now next is prepare one income statement. Similar questions were asked in ratio analysis chapter of intermediate syllabus, but they used to stop here only for 8 marks. But when you come to final, they start asking more. Then you have to find sustainable growth rate, G. Growth rate is equal to return on equity into retention ratio. Do you remember something like this you have studied? Retention ratio into return on equity. If dividend payout ratio is 20, retention ratio will be automatically 80%. But to compute the return on equity, you have to take earning after tax divided by equity shareholder fund. Equity shareholder fund is here. 200 plus 600. Share capital plus reserve. Okay. So that is your return on equity. And you can get the growth rate. So once you get the growth rate, then you can find the price of the share using dividend discount model. D1 upon K minus G. Give your opinion on the investment in the company share at the current price. Current market price is 28. You will get intrinsic value in answer 3. Compare intrinsic value with current price, like in question number 1 we did today, and you will be able to conclude whether we need to buy the share or not. Say yes. So did you like this question? Did you like my selection of question for your next exam? Do this type of question come in the exam? Read below what is written. May 2019 exam. The questions are repeated after 2-3 years. Okay. And now the high time that this question will come again. They keep repeating after 3-4 years. Okay. They will not repeat in the immediate exam. Anyway, why we are discussing non-core issues? We have to learn. Syllabus is vast. Anything can be asked. But I have tried to ensure that most of the concepts are covered in less time. So start with step 1. Calculation of sales and operating cost. Calculation of sales and operating cost, because first I need to find sales. Then only we can prepare the income statement. Right hand side rupees in lakhs. Point number A, total asset 1200. Point B, asset turnover ratio 2 times. Asset turnover ratio 2 times. Point C, write down sales. Sales will be 2 times of total asset. Nowadays this ratio is very important. Many investors check what is the asset turnover ratio, how much efficient is the company. Okay, so that is 2400. Then you write down point number D, operating margin. Operating margin means operating profit margin. Operating profit means earning before interest and tax, EBIT, 10%. So if operating margin is 10%, what will be operating cost ratio? Next line, operating cost ratio. Operating cost ratio is equal to 100 minus operating margin. 100 minus operating margin, 90%. Operating cost ratio means what is the operating cost as a percentage of sale. Very important for understanding the performance of a company. And next point F is operating cost. Operating cost is C multiplied by E. C into E, 2160. 2160. 2160 is right. So now we are in a position to prepare income statement. Step 2, write down income statement. Step 2, write down income statement. There is no fixed cost. This operating expense include all variable and fixed cost. Okay. Operating expense will include your cost of goods sold and variable cost, fixed cost, admin cost. Operating cost, write down 2160. Operating cost 2160. Therefore, EBIT 240. EBIT 240. EBIT 240. Less interest. That is 350 into 10%. 35. Therefore, EBT is C minus D. See the presentation in detail. 205 C minus D. Easy for the examiner to check. Point F, tax at the rate of 30%. So tax is 61.5. Earning after tax, E minus F. 143.5. Dividend at the rate of 20%. Dividend at the rate of 20%. 20% of earning. 20% of 143.5. 28.7. And point number I, retained earning. Retained earning. So how much is the retention? G minus H, 114.8. Suppose you don't want to write this is okay. Up to this is also okay. Not required, but in the institute answer it was written. Otherwise, income statement does not show retained earning. Okay. Now my first answer is over. Second answer is what is the sustainable growth rate. So I will first find out the retention ratio, because the growth rate formula is retention ratio into return on equity. So step 3, write down, dear student. Step 3, write down retention ratio. Step 3, retention ratio is 1 minus dividend payout ratio. 1 minus dividend payout ratio. 1 minus 0.20. So that is 0.80. Do you agree? So my next task is to find return on equity, ROE. Step 4, calculation of return on equity. Calculation of return on equity. Calculation of return on equity. So the formula will be PAT upon net worth, earning after tax upon shareholder fund. Earning after tax upon equity shareholder fund. Who will reply? Let us ask our student. PAT from the previous table. Net worth means share capital plus reserve. So PAT was 143.5. Share capital plus reserve 200 plus 600 is 800. Multiply by 100. So Prachi Kothari has given the answer 17.94%. You are right. Kothari ji is right. Okay. 17.94%. Wonderful. Now quickly give me the growth rate also. If you have got retention ratio and return on equity, can you not give me growth rate? Come on, growth rate. Growth rate. Step number 5. Growth rate G is equal to retention ratio into return on equity. Yes, come on, everybody. So our student Prachi has again replied 14.35%. Darshana Jaju has also replied same. Mehul Garg same. Is right, 14.35%. So this will give you 2 more marks. For each question you have 2 marks. There are total 4 parts. Do you want only 4 or you want to get 8? 8. Go ahead. Determine the price of the share of the company using dividend discount model. So now I have to find price per share. For that, first we will compute how much is the dividend per share given by the company today. So go to your previous table. You will find in the second last line of income statement, dividend paid was 28.70 lakh, correct? And number of share in the question book 20 lakh. Number of share 20 lakh. So please tell me, my dear student, what is dividend per share given by the company in the current year? Dividend per share is 1.435. Step number 6, price per share. They are asking you to use dividend discount model. So the dividend discount model is D0 into 1 plus G upon R minus G. D0 into 1 plus G upon R minus G. Solve. Who will give me the answer? D0 is 1.435 into 1 plus growth rate is 14.35%. So 0.1435 divided by 0.18 minus 0.1435. One student Prachi has already answered 44.96. Yes, you are right. Enjoy. Wonderful. You are a good candidate for the exam. 2 more marks for this. Do you want 2 more marks for opinion? Yes, this is the intrinsic value of the share. But the market price is just 28. The market price is just 28. So recommend buy or don't buy. Market price is lower than intrinsic value. Buy. Please reply everyone. All the students will reply buy. So most of the students are saying buy. So write down the advice. Students will write advice nicely. Just don't write buy, B-U-I. Since the intrinsic value is rupees 44.96, since the intrinsic value is rupees 44.96, Siddhana is saying undervalued. Very good. While it is selling at rupees 28, hence it is underpriced. Hence it is underpriced. It should be purchased. It should be purchased. So this was an 8-mark good question. If you have done practice in advance, you will get it right. So what are the possible mistakes? Asset turnover ratio, many students take asset by turnover. The whole answer will be wrong. Even growth rate formula, many students don't remember.
17.94% into 80% ऐसे हो सकता है.
Then also the answer is you will get same. Don't worry. So do practice it. One more different type of question. 5. May 18 RTP. But a good question. Something new to learn if you have not studied such question before. Question is SAM Limited has just paid a dividend of rupees 2 per share. Underline just paid. Just paid means D0. D0. And it is expected to grow at the rate of 6% per annum. Growth rate is 6%. Understandable. After paying dividend, the board declared to take up a project by retaining the next 3 annual dividend. Now what the board is planning, they are planning to undertake a new project, but for this they will need funds, and therefore they are not going to pay the dividend for the next 3 years. Is it right? If they do not undertake the project, then dividend will be 2 rupees plus 6%. But if they undertake the project, then dividend will be 0, 0, 0 for first, second and third year. Understood? It is expected that this project is of the same risk as the existing project, means same discount rate. It means same discount rate. The result of this project will start coming from the 4th year onward from now. So from 4th year onward, you will see the impact of this project. The dividend will then be 2.50 per share. So D4 will be 2.50 and it will grow at the rate of 7%. So the revised growth rate would be 7% if you undertake the project. If you do not undertake the project, growth rate will be 6%. Now up to this we have done so many questions in the class. What is new? This paragraph and then related question. An investor has 1000 shares in SAM Limited and wants a receipt of at least rupees 2000 from this investment. So you have made an investment in SAM and you want that every year I should earn at least 2000 rupees. So you can earn 2000 in 2 ways. One, dividend. Second, by selling the share. By selling the share. Am I right? If you are in the need of funds, by investing in a share, either you should get dividend or you should sell the share. If the company undertakes the new project, it won't pay dividend. Then how do you get 2000 rupees? By selling the shares. How many shares you will sell? 2000 divided by price of the share at the end of year 1. 2000 divided by price of the share at the end of year 2. 2000 divided by price of the share at the end of year 3. Because from the 4th year onwards, the company will start paying the dividend. Is it right? Required. Evaluate whether the market value of the share is affected by the decision of the board. So basically you have to solve this question 2 times. First, using this data, and second using this data, and check whether the price of the share today will be higher by undertaking a new project or not. Very easy. And next is recommend how the investor can maintain his target receipt from the investment for first 3 years and improved income thereafter, given that the cost of the capital of the firm is 8%. So this 8% is your KE, discount rate. Okay. So let us solve this question. First write down step 1. Step 1, heading write down value of share at present. Value of the share at present before undertaking the project. Before undertaking the project. P0 equal to D1 upon K minus G. P0 equal to D1 upon K minus G. Last dividend was 2 rupees into 1.06 divided by 8% minus 6%. Rishabh got it right, 106. What about other student? Have you also got 106? (106) is right. Okay, go ahead. Step 2, write down value of the share after undertaking the project. Value of the share after undertaking the project. Write a note. No dividend would be payable for 3 years. No dividend would be payable for 3 years. And dividend for year 4 would be rupees 2.50. And dividend for year 4 would be rupees 2.50. Next line, growth rate is equal to 7%. Growth rate will be equal to 7%. So we are given D4 and revised growth rate. So if D4 is given, then by applying this perpetuity formula, you will first get the price at the end of year 3, and that will again be discounted by the third year factor to get the price at the beginning of the year 1 or today, P0, like we have done in question number 1. Okay, so directly you will not get the answer. First you will get P3, then from P3 we will get P0. Right, P3 equal to
CGF of the third year, right?
Yes. See, if this is the timeline, this is D4. So by applying the formula, you will get P3. Then you have to again discount it to get P0. So you have to discount by 3-year factor. So 2 steps will be involved. Students again make a mistake. They take this only as a final answer. Write down 2.50 divided by 8% minus 7%. So P3 will be equal to 250. Very good. Those who are replying, very good. But don't stop here. Get P0 also. P0 will be equal to 250 divided by 1.08 to the power 3, which is equal to, Siddhana is right, 198.46. 198.46. Yes, 198.46 is also okay. So this is your first answer. Whether the market value of the share is affected by the decision of the board. From 106 rupees, it has moved to 198.46. So the answer is yes. Write a note. Every time write a note as per the question. The price of the share is expected to increase. The price of the share is expected to increase from rupees 106 to rupees 198.45 or 46, whatever. Price of the share is expected to increase from rupees 106 to rupees 198.45 after the announcement of the project. Okay. Now the question is, the investor wants 2000 rupees every year. The investor wants 2000 rupees every year. Understood? But company is not going to pay the dividend. So you will have to sell the share. So I need to find price of the share at the end of year 3, year 2, year 1. Year 3 already we have computed 250. So write down, the investor can take up this situation as follows. The investor can take up this situation as follows. You can just save time by writing price, calculation and rupee. P3. P3 will be directly write 250. Already calculated. P3 250 already calculated. Then write down P2. P2 will be, this is the price of the third year. So if you discount it by 1 year factor, from P3 it will become P2. So type 250 divided by 1.08. 250 is here. You have to bring it to year 2. So gap is 1 year. So just simply you take 250 divided by 1.08. That will give you price at the end of year 2. How much? 231.48. Don't write so much. You can just write down 250 divided by 1.08. And year 3 write down. P1 write down. P1. Take this number and divide by 1.08. Take 231.48. Write like this, 231.48 divided by 1.08. Just bring it down by 1 year. Yes, Rishabh, come on. So he is getting 214.33. These are the prices of the share at the end of year 1, 2, 3. Up to this is understandable. Now step 3 write down. Number of shares the investor should sell. This part of the question is new. Normally it has not been asked in the exam. Price, number of share investor should sell to maintain receipt of rupees 2000. To maintain receipt of rupees 2000, draw this table. Year, minimum amount required, price per share, last column number of shares to be sold, year 1, 2, 3 write down. Minimum amount required 2000, 2000, 2000. Price per share as per previous table. 214.33, 231.48 and 250. Now divide. Round off on the higher side, because if you round off on the lower side, you will not realize 2000 rupees. So check the answer. Is it 10? Is it 9? 8. So total how many shares you will have to sell? 27. Number of shares sold in 3 years is 27. Very good, Rishabh. Now he had 1000 share in the beginning. He sold 27. So number of shares left at the end of year 3. Number of shares left at the end of year 3. Is it 973? Now, can he get 2000 rupees or more in the 4th year from the dividend? Let us check. Dividend of the 4th year is 2.50 and he has got 973 shares. So do you think he will be able to get 2000 rupees? How much you are getting? 2.50 into 973. Yes. So now you write down one more line. His dividend income for year 4. His dividend income for year 4 will be 973 into 2.50. 973 into 2.50. Is it 2432.50? Yes. Which means he does not have to sell share after fourth year, and it will grow only. It will grow at the rate of 7% every year. So write a note and complete the answer. This answer is over, subject to this note. One student has a doubt in the classroom, physical classroom. Yes, please ask your query. Ask slowly. I will repeat query also. We got P0 we have got. That was price today. You can do reverse working also. You can do reverse. Answer will be same. From P0, if you multiply by 1.08, you will get the same answer. Yeah, discounting and compounding will give you same answer. Whichever way you can do. Again, you can take P1 and into 1.08. You can take P2 into 1.08. You are doing the same thing. If you want to present like this for P1, P2, P3, you can do it. Just write a note and complete the answer. Write this note. One more confusion. No, the discounting and compounding are same thing. One takes you to the future, one takes you to the present. Write down a last line. Thus, if the project is taken up by the company, the investor should be able to maintain his receipt. The investor should be able to maintain his receipt of at least rupees 2000 for first 3 years, and would be getting increased income thereafter. So today we'll stop here. We'll continue tomorrow at the same time. So please be present. I hope you enjoyed today's lecture. Those who are at home, kindly reply. Did you enjoy? Say yes. You can say no also if you have not enjoyed.
Are you feeling overstressed by your CA syllabus? Get the best CA revision lectures by top CA leaders, specially designed to boost your confidence and knowledge. And the best part of the lecture is that they are available at super affordable prices and available at any time, anywhere. So hurry up and place your order from our website Vinod.in. It is a perfect solution for your last minute